So it's funny, and I had prepared this introduction, but the comptroller just said something to me on the side that I'm sorry I'm going to repeat. Titles come and go, right? And we're just, call me Jonathan. We're here to have a good conversation. And to me, that is really all you need to know about Comptroller Gould. I often say when I talk to members of Congress that the best members of Congress started in the state legislature. I'd say the best regulators started as staff in those regulatory offices because you understand fundamentally sort of the inner workings of the organization. And you had the privilege of serving under, I think, 2 comptrollers, right? Appointed under Comptroller Otting and then stayed, I think, through the end of, through Comptroller Brooks. Serving as general counsel, I think chief deputy comptroller. You've also had the opportunity to serve in the private sector. And so you've seen kind of both sides. You've seen, sort of everything. And to me, that's really what makes the best leader for an organization like the one you're at. And as Howard just said, and a tremendous thank you to Howard and to the Utah Bankers Association, and of course to John Sun. Coming to this job with that kind of experience really gives you, I think, sort of an opportunity and an advantage over many who came before you. And so how do you see, I guess, what drove you to sort of the regulatory space, and how do you see the future of the agency under your leadership?
Well, thank you very much for the introduction, Howard, and thank you so much for having me here today. It's exciting to be here. So I've had the benefit of having a lot of great mentors over the years, including obviously my predecessor, Joseph Otting, the 31st comptroller. And I did serve actually under 4 acting comptrollers, Brian Brooks, Blake Paulson, as well as Mike Sue. So a lot of different folks over the time. I left in June 2021, so kind of ensured kind of hopefully a good transition, smooth transition before I got out of there. A couple things I think from my experience. One that really kind of inform my sense on the job. One is I bring a sense of urgency. Titles do come and go. I'm not going to be here forever. One of the things I learned the last time I worked in government is that every day counts. You need to really push aggressively and hard because it'll be gone before you know it. So just aspirationally, I try to, in fact, make every day count. I'm sure I fall short many times of living up to that aspiration, but that is my goal. I also have a pretty broad-based experience in risk management generally, including from before 2008. So I know what the world looked like from a supervisor and regulatory point of view before 2008, and a lot of changes that were made, some understandable, some I think misinformed and counterproductive. I also have a sense of just the legislative process and was there working for Senator Mike Crapo, the then chairman of Senate Banking, back in 2018 when the Senate passed the Economic Growth Act, which mandated tailoring of regulations for banks. And so I take that to heart. Congress meant it when they passed the law. And it's my obligation to ensure that we comply with both the letter and the spirit of the law. So that's something very important for me as a comptroller. More generally, I want to make sure that I'm not kicking cans down the road. There are a lot of agency management and operational issues, so things that are perhaps not as exciting to all of you at this conference, but that inform and impact the way the OCC does its job on a daily basis. Things as mundane as human resource function, IT function, so getting those back to where they need to be is very important to me. On the banking policy side, there's a huge amount of work to do, and I've only been there 60 days, but we've already kind of made some announcements, like elevating our chartering and licensing function, so it reports directly to me, making changes to our supervision portfolios, so they reflect the promise of supervisory tailoring, having a specific supervision portfolio group that is dedicated to community banks. That was really important to me, so we put that in place. Just a couple of weeks ago, I think we announced it. Dropping assessments immediately across the board for banks by up to, I think, 30% for banks up to $40 billion in assets, so trying to reduce the burden on banks. We will have in the next week or so a series of announcements around relief we're providing to community banks on the regulatory and supervisory front, as well as kind of indicating some changes to come in the future. So we're trying to move quickly across a bunch of fronts. There's a lot to do. But in general, obviously very excited to get the chance to go back to the OCC. It's an agency that I have the highest respect for and one that I think really has an opportunity to lead going forward here.
So it's funny, given we just talked about your experience, given your experience, one can argue and sort of give you a pass if you said, hey, I'm just going to hunker down in my office. And yet this week alone, You're literally sort of on site in Tennessee, you're here in Utah, you go from here to somewhere else. How important is that engagement on the ground with your regulated entities?
Yeah, so I think it's really important for multiple reasons. So I think the week before last, I was in Tennessee on a bank exam. It was, I think, the first time in 20 years that a comptroller has actually been on a bank exam. This is not going to be a one-off event for me. I intend to do it on a regular basis. It's highly informative to me to understand kind of what's going on, the pain points, both for bankers as well as for examiners. It also kind of telegraphs the point that, our business is not in DC. Our business is all around the country where banks are. And so that's really important for me to, I think, signal that to all the team at the OCC, that I'm out there with them in the field, seeing what they see, so that I can make changes to kind of improve both the effectiveness of our supervision, and also just kind of, if I'm not willing to do something, then why should the people that work for me be willing to do it? So I need to kind of telegraph to them that I'm out there with them. So that's important to me, and seeing and hearing from banks directly. I mean, one of the things that's important to me too is just to telegraph, I think, the geographic breadth and the business model scope of the national bank charter, which I think sometimes has not been so well kind of noted in the past. So that too is important to me.
I don't know about anybody else here, but I'm legitimately excited, not just about what you've already accomplished, but literally what is ahead. But oftentimes, and I say this about sort of the American Fintech Council membership banks, right? And so we represent both fintech companies and innovative banks. They come in all shapes and sizes, right? The OCC sort of regulates sort of the smallest banks and some of the most systematically important banks. How do you balance sort of an equal regulatory approach or an equal approach to both to ensure that they each have their own opportunities to be successful?
So I think sometimes people overthink this one a little bit. If we are actually practicing risk-based supervision, that should all be taken care of. So the problem is that we are not always practicing risk-based supervision. I was somewhat surprised and alarmed to hear when I got to the OCC that people were telling me that we're newly refocusing on risk-based supervision. And my immediate question was, well, what have we been doing for the last 30 years? Comptroller Ludwig under President Clinton, introduced the innovation of a risk-based approach to supervision, which to me makes common sense. And so we're kind of refocusing on what exactly we're doing on the ground. Are we in all cases actually doing risk-based supervision, or are we just doing kind of a checklist approach to supervision, sent from some centralized command and pushed out to the field offices? Long term, I want to return a lot of kind of autonomy to the local examiners who know the banks and their portfolios the best, so they can correctly assess, okay, this is what we need to do now, today, versus being bound by some central strategy that was sent out from on high, a year in advance of the actual examinations on the ground. So one thing is obviously having a real risk-based supervisory approach, which involves potentially, some changes in how we think about and how we do things and how we plan for things. The other thing we can do is hardwire and regulation some of this tailoring, which should help as well. As I mentioned, we've set these kind of different supervisory portfolios based on asset thresholds. Asset thresholds are, inherently a rather poor proxy for business model or complexity. But it's what Congress has tended to use in the past. It's what the OCC has used in the past. And obviously, we kind of reserve the right to move things around as we see fit based on actual risk profiles. But that is one way that we address it too. Another thing we're trying to do to put our kind of risk-based supervision approach on firmer ground is to hardwire into, say, the definition of what constitutes an unsafe and unsound practice or condition. We want to hardwire that in regulation. You'll see soon a proposal from the OCC and the FDIC on this front as well, which again should make us much more focused on material financial risks versus kind of burying bankers under a deluge of at some points what has become, I think, a distraction from focusing on things that really matter. I don't want to see our supervisory approach diluted or continue to be diluted. I want it kind of refocused on what actually matters, which are kind of, again, core and material financial risks.
It's interesting when the risk-based approach is the novel activity is always is refreshing, but that is sort of strange, and we're excited to sort of be back to that where, regardless of size, ultimately comes back to what you're doing and how that's going to impact. So how do you see the difference? How do you sort of, I'd say, balance? We just talked about big and small banks, but what about innovative banks and non-innovative banks? And we talked about risk-based approach. But how do you also balance the needs from the examiners all the way up to sort of what's happening in Washington in terms of finding new ways to encourage their innovation, kind of pushing them to create new innovations, new efficiencies, new opportunities without sacrificing sort of the integrity of the financial system?
So one thing just conceptually at the outset is that I take kind of a broad view of risk management and my responsibilities as comptroller of the currency. So what that means, I think, with respect to your particular question is, it could be a very real source of risk to the banking system if banks don't innovate over time, okay? And so, yes, innovation, engaging in new activities or embracing new technologies can, sure, be a source of risk, but so too can the failure to embrace them as well, right? And so I think my job is to ensure that basically to ensure that banks have as many paths to long-term viability and relevance as possible. And that includes ensuring that banks can, if they so desire, embrace new activities and new technologies consistent with law and in a safe and sound manner. One of the things I think has occurred in the past is that regulators have sometimes taken the view that risk management means risk elimination and trying to build a wall around the banking system. That may have some benefit in the short term, but that's not our charge as regulators. Especially for an agency that's 162 years old, right? We need to take a longer term perspective of risk and what it means to be steward of the federal banking system. And so when I think about it, I think about not just the short-term risks to the system, but the long-term risks to the system and the failure of banks to embrace new technologies, whether it's AI or whatnot, or distributed ledger technology, or whatever it might be. Again, subject to them thinking that it helps them, the bank, serve their customers, markets, and communities better. But I want to make sure that we as regulators don't kind of look at otherwise legally permissible activities or technologies and kind of throw up our hands and say, well, that's really hard to figure out how to do that in a safe and sound manner. So we're just gonna take the default approach of more or less shadow banning it. That is not the right strategy. That is a failed strategy from a long-term and from a risk management perspective. It's our job to work with industry to figure out how to do these activities in a safe and sound manner going forward.
Give him a round of applause. That deserves it. I tried to write it as you were saying. I hope we're recording here because I was trying to write it as you were saying it because this is a clip that's going to end up on our website later today, hopefully, if we can get our IT correct. Again, it shouldn't be refreshing to hear the currency or the FDIC say things like you just said because I don't think it was that controversial. I think it's for the folks in the room, for the industry, that's what they're trying to accomplish. And so going specifically maybe to AI, how do regulators keep pace? Right? How do we make sure, am I good? How do we ensure that regulators are keeping pace, right? You have innovators in this room that are moving at the speed of innovation, at the speed of as quickly as they possibly can. And oftentimes you find that regulators are not embracing innovation within their own agencies. And so all of a sudden you have a mismatch and the regulators are not as innovative as the entities they're trying to regulate. And so how do you think about that maybe specific to AI as things continue to move even quicker? How do you think about that from the agency's perspective?
Yes, okay, so we're probably, this is probably obvious, but we're never going to be as innovative as some of the banks that we supervise. That's just the reality. We're always going to be playing some degree of catch up just because we have all kinds of impediments that are maybe not in all cases immutable characteristics of federal government, but at least our challenges. So we're trying to deal with that. We generally have a pretty supportive attitude across the executive branch these days around the adoption of different types of AI. I think a couple of weeks ago there's an announcement about one of the federal government agencies securing on behalf of all of us the ability to use large language models, including those that importantly don't cause, for example, like our confidential information, our CSI, bank CSI, to actually leave our systems, which was a potential impediment to our use of AI. I mean, speaking at the OCC specifically, I mean, we have some challenges. Forget about using AI. We have some challenges just generally around IT. So we got to kind of get to a better approach to our use of IT, just generally, much less being able to use kind of AI-empowered tools to improve both our agency management and operations, as well as how we do supervision. That's going to take a little while to get there. I think the question around banks that we supervise, how to ensure that there are as few paths as possible for those banks that want to embrace new technologies like AI. I mean, so there's some. I mean, first one is just kind of an attitude change, right? Which is what I've already noted, which is that if something is legally permissible, which obviously these things are, the question is, how do it's our job now to help you all do it in a safe and sound manner. So that's just kind of an attitudinal and cultural change. Then there are kind of specific issues, like for example, model risk management, where essentially, if AI falls into the trap of being deemed a model, we're all kind of screwed, right? I mean, our current approach to model risk management really needs to be revamped and revised because it is impeding the ability of banks to take advantage of things like AI, it seems to me, or potentially could do so. So we need to address that, and I think in the short term, with respect to AI specifically. I think those are kind of the, from the general to the specific that we need to do.
Hold on, I'm having. Sorry, test? Okay, sorry about that. And so how do you think about, again, sort of the way in which banks are implementing AI, right? Some are using it for credit decisioning, to customer service, to consumer complaints, and everything in between. So what are the key risk management considerations? Now that we're talking about risk management, like how do we think about those considerations and how do you prioritize them as you think about embracing kind of regulatory structures in AI?
So let me just go back and say one thing. I mean, one thing that I'm really worried about is I don't want to, AI, I think, has the tendency or could have the tendency to help level the playing field among and between banks. It can be, I think, democratizing, but only if all banks, if they so desire, can embrace it and have a path towards embracing it. One of the things I'm worried about is the creation of some kind of a two-tiered system, which we've seen in other cases where only the very, very, very largest banks have the sophistication of risk management or the massive balance sheets such that regulators feel comfortable with them doing something new, whether it's, again, a new technology like AI or some new activity like, say, for example, digital assets. That I really want to avoid. I mean, you can see from a supervisor's perspective why that's vaguely attractive, but it has the benefit of creating this two-tier system. We've seen it in the past around things like derivatives use. Like certain derivatives activities are largely confined to the top half dozen banks or so in America. I do not want to see that pattern replicated with respect to the use of AI because, again, I think AI could actually help small banks quite a lot going forwards, whether in back office operations or, again, other things going forward. It could also potentially reduce some of their reliance on certain core systems long term and access to core systems for technology. In terms of just embrace of AI and thinking about basic risk management, I mean, there's kind of data quality, data governance. There's issues around making sure you kind of understand what you're using it for, making sure you kind of have appropriate roles and responsibilities assigned, a certain amount of kind of human overlay as necessary, particularly if you're using kind of agentic AI, like stuff like that. So I mean, I think those are kind of the things that I would expect. I don't, in all cases, pretend to be an expert on all these things, but I think a lot of it's just basic common sense. if you're a competent risk manager, you can figure out ways to responsibly engage and use AI to help you do your business.
I would actually sort of go farther and say that smaller banks probably have an advantage here, right? They're a bit more nimble, some, I should say, are a bit more nimble in taking advantage of some of the partners and some of the opportunities in AI. Let me ask you somewhat of a different question. We look back over the last few years when things we were getting additional guidance in banks that were operating in the fintech space, things like third-party risk management and additional guidance. What we were more excited, more than just the guidance, because the guidance was never that exciting, right? What we were more excited was that the agencies were working together. Right now, there's an acting chairman, Travis Hill, is at the FDIC. You guys go back a long way as well, right? You're amongst your regulatory colleagues, there are people who go back and have a long history together. Have you found that those relationships have helped you work together so that things and ideas that come out of the OCC are easily adaptable to the FDIC and vice versa?
Yes, absolutely. And I think, you mentioned that the acting chairman, he and I both worked for Mike Crypto together. In the first Trump administration, we worked extremely closely. Again, I at the OCC, he at the FDIC. So I'm, obviously very excited to, be on the FDIC board and get a chance to work with them again, both on the FDIC board, but also across agencies. You'll see that we're already collaborating on a number of things. We have a reputation risk rule. We'll have this, I mentioned this unsafe and unsound practices rule that we also work together on. So a lot of great opportunities there to work together.
Did you see him smile right there? That sort of, again, it's amazing. It's amazing.
That's some of the most fun stuff is, right, kind of conspiring with your other agencies and how you can pull, get stuff done. That I will say in the first Trump administration, that was some of my most joyous moments, was kind of working across the agencies with some of my friends to get things done.
So dare we have somebody like you speaking at a fintech conference and not talk about digital assets? I'm sorry, we have to do it. But maybe specifically to what we've seen lately around debanking. Obviously, there's been a lot of press and a lot of coverage of the idea of debanking and what was done potentially, or sort of what was done in the last administration. How have you looked at the issue of debanking, and more importantly, what have you put in place or have thought about to prevent things like debanking, maybe for entities that working in the digital asset space, but maybe for the next innovation that we haven't yet heard of? How do you make sure that there's a pathway forward?
So let me just go. You mentioned third-party risk management, so I got to mention something there briefly, if you don't mind. So the situation and the inability of banks to partner with fintechs or third parties, that is not sustainable. Banks of all sizes, but particularly smaller banks, need to be able to partner responsibly with third parties, whether it's for access technology or balance sheet capacity or whatever it may be. The situation in the last few years has been like a disaster on that front. I will tell you, I have a lot of good friends who are in the operational weeds on how to make these relationships work. And there are a lot of problems that we deal with, some of which are kind of intractable or largely intractable. My friends have assured me this is definitely solvable, and so I'm working actively with them to chart a path forward so that banks can actually partner with fintechs. And the reality, of course, is over time, all these things are going to converge, right? It always starts out with these kind of seemingly antagonistic, right? But then they converge over time. Same is kind of true with digital assets. At first, it's we don't like this stuff. It's a threat to us. And then the next thing you know, 4 years later, it's well, actually, we want to be the ones to do it. And we want to be the only ones who can do it, right? And then that changes over time. So on debanking, yeah. So obviously there've been a lot of, I think, documented evidences, and I've seen this among friends. I worked in the crypto industry back in 22 for a while as well. Didn't happen to me, but certainly there was effort to shut crypto firms out of the banking system on multiple levels that involve prohibiting banks from engaging in the legally permissible activities related to digital assets, whether it be custody or stablecoin issuance and so forth. Or, honestly, probably even more kind of egregious, preventing banks from actually banking crypto companies or people who just happen to work at a crypto company. And I've seen that occurring still as recently as a couple months ago. So that is a real issue. So we've done a couple things to try to address that in response to the President's EO. One is we've got this reputation risk rule, which is coming out, which is going to, tie our hands going forward, so the regulators themselves won't be able to put pressure on banks to do this or that under the guise of reputation risk. Another issue that we're working on, which is a longer-term issue and a little bit harder to solve and involves, obviously, Main Treasury, is BSA/AML compliance, which is also sometimes used as a pretext to debank for other reasons. Obviously, BSA/AML compliance is very important. The public policy objectives that those laws serve are of paramount importance. But I think BSA/AML compliance is crying out for reforms and automation, candidly. I don't think we need these massive billion-dollar or multi-billion-dollar even cottage industries that have sprung up over the last kind of 15, 20 years. It is a huge burden for banks, and we need to think of a better way to do it while still achieving, again, the very important public policy objectives that underlie our BSA/AML laws. I think that's doable. That's something we've been talking about with Maine Treasury and look forward to working with them, other agencies on. The other things we've done in the debanking space, so we are, actively looking into the largest national banks and what they may have done in this space. And in particular, a few years ago, some of them were pretty public about basically, actively debanking certain kind of politically disfavored industries that were nevertheless engaged in lawfully lawful activities. So we're looking into that. I guess the most important message I could deliver to you today is that that's not an accident. We're focused on the very largest banks. This is not a phenomenon that I've seen or am aware of occurring at smaller banks. This is not about, trying to force banks to engage in activities where they have no competence at all to do so. Again, we're just trying to really be targeted in what we look at, where we think there may have been problems in the past, and try to make sure it doesn't happen again. Again, that's why we tried to use the licensing process and the Community Reinvestment Act process as well as a way to surface any allegations of this. We're also kind of pouring through our own complaint data and working with third parties for their complaint data. Because again, that's a challenge on debanking too, is what do we mean by it, and to what extent is it actually occurring? And then again, where has it occurred at what banks? And again, my anecdotal evidence that I have suggests it's really only the very largest banks.
So in closing, first, I think a message from all of us that fintech business casual is different than normal business casual, okay? So I just want to put that out there.
Thank you. I'm working on it.
How do the folks here engage? I think, again, we're going to get this, on our website hopefully today. How do they engage? Who should they reach out into to your office? Who can they be in touch with? How do you think about more than just joining your favorite trade association? How do individual companies maybe engage with organizations like the OCC and other federal organizations?
I feel like I sound like Hester Peirce over the SEC, early and often, right? So, please come in and talk to us. If you're getting resistance or, people aren't being responsive, let me know. One of the things I've tried to communicate with the OCC is that there aren't any gatekeepers anymore, right? So, if you want to talk to kind of like to me or my front office, please reach out. We don't want people to be standing in the way, whether it's supervision or legal or kind of our chartering function. But we're trying to send a different kind of attitude out there and kind of change the culture around our receptivity for engaging kind of and seeing things that are novel and new. De novo charter is another example, right? I mean, the record for de novo chartering in this country has been pretty abysmal for a while now, maybe since 2008. We got to fix that. When I hear like certain agencies say, "Oh, this looks different," well, it looks different because you literally haven't approved anything in 20 years, right? Like you haven't seen anything. So we got to recognize that markets are changing. The financial services world and the banking world is constantly changing too. It's very competitive. Maybe we're going through a generational change right now. That's not something to be feared. That's something to be embraced, because I don't want the banking system to become less relevant over time. It's been one of the crown jewels of our larger financial services system. So please, we really welcome and need your input. Again, whether it's through trade associations, whether it's through formal engagement on rulemakings, or informal just reaching out to us and telling us, where we need to do things. And just because I worked at the OCC, please don't assume that, I know everything, or that, if you see like, the OCC isn't doing X or Y or Z that they should be doing, it might just be because I don't know to do those things. So, please tell me, I do kind of need your help and guidance on where we should be focused and where we can have maximum kind of bang for our buck.
I feel bad for the rest of this conference and the rest of the speakers, because I'm not sure how we're going to top this conversation. A huge round of applause for Comptroller Gould for everything you're doing. We're excited for our continued partnership.